Did you know that 80% of people who start investing in the stock market end up losing money in the first 5 years? Sounds crazy, right? And here's the kicker. Studies show that even though the stock market has returned an average of 10% per year over the last century, most investors don't even come close to that. They get caught up in trends, panic during market dips, and pull out too soon. But here's the good news, it doesn't have to be this way. What if you could learn how to invest smartly, build wealth, and avoid the mistakes most people make? In the next few minutes, I'll show you how to change your investing game in just 90 days. I'm talking about a strategy called value investing. It's the same method used by some of the world's wealthiest people, like Warren Buffett, and it's not as complicated as it sounds. Stick around, and I'll walk you through simple steps to find hidden stock gems, avoid the latest hype, and set yourself up for financial success. Ready to learn how to stop wasting time and start investing like the pros? Let's get started. Chapter 1. The Power of Patience. Transform your wealth, one investment at a time. When it comes to value investing, patience is your best friend. You see, it's not about making quick profits, but about slow, steady growth. This strategy hinges on understanding that building wealth takes time and discipline. One of the best examples of this is Warren Buffett, who often says, "The stock market is a device for transferring money from the impatient to the patient." He's right. Most people want instant results, but value investing is different. It rewards those who can look beyond short-term fluctuations and focus on long-term gains. In fact, Buffett's strategy of buying undervalued companies and holding them for decades has made him one of the world's wealthiest individuals. By adopting the same approach, you too can grow your wealth over time. The key is to understand that compounding works best when you give your investments time to grow. The longer you wait, the more you benefit. Think about it. If you had invested $1,000 in Coca-Cola in 1988, it would be worth over $40,000 today. That's the power of long-term investing. But how do you become patient? First, start by embracing a long-term mindset. Don't get distracted by the daily fluctuations of the market. Instead, focus on the fundamentals of the companies you invest in. Look at their earnings, debt, and management. If these factors remain strong, then market ups and downs won't affect you as much. The next step is to reinvest your profits. Many people make the mistake of cashing out their gains too early. By reinvesting, you allow the power of compounding to accelerate your returns. Remember, it's not just about making money, it's about making money work for you. Finally, understand that patience doesn't mean doing nothing. It means being proactive in your research and continuously evaluating your portfolio. Stay informed about the companies you own, and when you see great opportunities, take action. Don't let fear or impatience steer you away from making the right decisions. If you found this helpful, don't forget to subscribe. In Chapter 2, we'll dive into how you can shift your mindset and start making smarter investments today. Chapter 2. The 90-Day Transformation Blueprint. Building your value investing mindset. Changing your financial life in 90 days is possible, but it starts with transforming your mindset. It's easy to get lost in the excitement of fast returns, but value investing isn't about that. It's about learning to think differently, to look beyond the noise, and to focus on what truly matters. Start by committing to learning something new every day. Reading one article, book, or financial report each day can make a huge difference. For instance, you could start by reading The Intelligent Investor by Benjamin Graham, the father of value investing. In his book, Graham talks about the importance of investing based on fundamentals, not market sentiment. Set aside time every day to track your investments. You don't need to obsess over the stock prices, but understanding the business and its performance is key. Begin by evaluating companies you're interested in. Look for businesses that are undervalued but have strong fundamentals. This process will help you see opportunities others may miss. Create a 90-day challenge for yourself. Pick a stock, research it thoroughly, and invest only when you're confident in its long-term potential. This challenge will force you to adopt a disciplined, patient mindset. During these 90 days, aim to build your investing knowledge and refine your decision-making process. A good rule of thumb is to always ask yourself, will this company still be around in 10 years? If you can confidently answer yes, then you're on the right track. Warren Buffett's favorite holding period is forever, And while that may not always be practical, the idea is to invest in companies with lasting power. During your 90-day journey, track your progress. Celebrate small wins, like identifying a solid investment or learning a new investing principle. These little victories will keep you motivated and engaged in the process. If you're enjoying these tips, hit that subscribe button. Chapter 3 is coming up next, where we'll discuss how to spot undervalued stocks that can change your financial future. Chapter 3. Hidden Gems. How to find undervalued stocks that will change your future. Finding undervalued stocks is the essence of value investing. The challenge is knowing where to look. Often, the best opportunities are in places most people overlook. These hidden gems are stocks of companies that are temporarily undervalued but have strong growth potential in the long run. So, how do you find these gems? Start by screening for companies with low price to earnings (P/E) ratios. This can indicate that the stock is undervalued relative to its earnings potential. However, a low P/E ratio alone isn't enough. It's important to dig deeper into the company's financials. Look for companies with strong balance sheets, minimal debt, and solid cash flow. A company that generates consistent revenue, even during economic downturns, is a good candidate for value investing. Remember, you're not just buying a stock, you're buying a piece of a business. So, you want to make sure that business is well managed and financially sound. One strategy is to focus on companies in industries that are out of favor but have strong fundamentals. For example, in 2008, many people avoided banks and financial institutions due to the financial crisis. However, those who were able to identify strong banks at discounted prices were handsomely rewarded when the market recovered. Another way to find hidden gems is by researching companies that have a competitive advantage. This could be anything from a strong brand, like Apple, to a unique product, like Tesla's electric vehicles. Companies with a clear competitive edge are more likely to perform well over time. Lastly, don't forget to look at insider buying. If company executives and insiders are purchasing shares, that can be a good indicator that they believe the stock is undervalued. Their investments show confidence in the company's future prospects. Finding hidden gems takes time, research, and a little intuition. But when you do find them, they can become the cornerstone of your long-term wealth-building strategy. And remember, just like any treasure hunt, the best finds often come when you least expect them. If you want more tips on finding valuable stocks, don't forget to subscribe. In Chapter 4, we'll explore why chasing trends is a dangerous game and how you can avoid it. Chapter 4. Stop chasing trends. The dangerous game of following the herd. It's easy to get swept up in the excitement of the latest investment trends. The media buzzes with stories about new tech stocks, hot IPOs, and the next big thing. But value investing teaches us a different lesson: don't follow the herd. Chasing trends might give you a temporary thrill, but it rarely leads to long-term success. Take the dot-com bubble in the late 1990s as an example. Many investors jumped on the tech bandwagon, pouring money into companies with little more than an idea and a website. At the peak, some of these stocks were valued at over 100 times their earnings. But when the bubble burst in 2000, those same investors saw their portfolios crash. If you had avoided the herd and focused on companies with solid fundamentals, you would have fared much better. This is why value investors look for stocks that are undervalued, not trendy. Trends are often fueled by emotions, and emotions can cloud your judgment. In contrast, value investing is about analyzing data, not reacting to the latest headlines. As the legendary investor Benjamin Graham said, the investor's chief problem, and even his worst enemy, is likely to be himself. Value investors avoid emotional decision-making and stay focused on the numbers. The key to success is ignoring the noise of short-term trends and instead thinking about the long-term potential of the companies you invest in. For instance, even during market crashes, strong, undervalued companies can weather the storm and come out stronger. The market may get caught up in trends, but your focus should be on the intrinsic value of the business. Next time you feel the urge to chase a hot trend, take a step back and ask yourself, is this company fundamentally strong? If the answer isn't clear, it's better to wait for a more solid opportunity. Your goal is to find investments that make sense, not ones that are popular for the moment. Like this advice? Subscribe for more insights. In Chapter 5, we'll cover the 3 pillars of value investing that can serve as the foundation for your financial freedom. Chapter 5. The 3 pillars of value investing. Your foundation for financial freedom. Value investing is built on 3 core principles that serve as the foundation for financial freedom: intrinsic value, margin of safety, and a long-term horizon. Understanding and applying these principles will guide you toward more thoughtful and profitable investments. Intrinsic value is the true worth of a company based on its fundamentals, things like earnings, revenue, and assets. It's the price you should pay for a stock if you want to own it long-term. To calculate intrinsic value, you need to look at the company's financial statements, industry trends, and future growth potential. Warren Buffett famously said, "Price is what you pay, value is what you get." This quote reminds us that market prices can fluctuate, but the true value of a company remains stable if its fundamentals are strong. Margin of safety is the buffer between the market price of a stock and its intrinsic value. In simple terms, it means buying stocks at a price lower than their intrinsic value to reduce risk. This principle is one of the cornerstones of value investing. By buying stocks with a significant margin of safety, you protect yourself from market volatility. For example, if a stock's intrinsic value is $100, but it's trading at $70, you have a $30 cushion to help shield against unexpected downturns. Long-term horizon is perhaps the most important pillar. Value investing isn't about making quick profits, it's about holding onto investments for years, sometimes even decades. When you buy undervalued stocks with strong fundamentals, you want to give them time to grow. As Buffett puts it, our favorite holding period is forever. This long-term approach minimizes the stress of market fluctuations and allows your investments to compound over time. By focusing on these 3 pillars, you'll create a solid foundation for your financial future. Intrinsic value helps you find good deals, margin of safety protects you from risk, and a long-term horizon ensures you benefit from compounding. These principles will guide you through both good and bad market times, leading to more consistent, reliable results. Interested in building your wealth through value investing? Subscribe now, because Chapter 6 is about to show you how to make your first value investment today. Chapter 6. The time is now. How to make your first value investment today. If you've been waiting for the perfect moment to start investing, now is the time. Value investing is all about making smart decisions based on research, not timing the market. The best time to invest is when you've done your homework and found a stock that meets your criteria for value. Start by choosing a company with strong financials, a solid management team, and a proven track record of success. Don't worry about the short-term ups and downs in the stock price. Instead, focus on the long-term potential of the business. For instance, consider companies like Johnson & Johnson, which has consistently delivered solid returns for decades. It may not be the flashiest stock, but its stability and growth make it a prime candidate for value investors. Next, set clear investment goals. Do you want to invest for retirement? Are you looking for a steady income stream? Defining your goals will help you stay focused and avoid emotional decisions. Once your goals are clear, you can better evaluate which stocks align with your long-term vision. Before investing, calculate the stock's intrinsic value. Is it undervalued? Does it offer a margin of safety? If so, go ahead and make your first purchase. You don't have to invest a large sum right away. Start small, and as you gain experience, you can increase your investments. The key is to start now and avoid procrastination. Finally, be prepared to hold your investment for the long term. The first few months may be volatile, and you might be tempted to sell. But remember, value investing is a marathon, not a sprint. Trust the process, stay disciplined, and let your investments grow. By making your first value investment today, you're setting yourself on a path toward financial freedom. The sooner you begin, the sooner you'll benefit from the power of compounding and the wisdom of long-term investing. Don't wait for the perfect moment, start now and build the future you want.